Meghan, this is an interesting time in the markets ahead of what's anticipated to be a September rate cut. How exactly do you think investors should be positioned ahead of that almost certainty being priced in?
Yeah, Dominic, thank you for having me. We are definitely encouraged on the market. And even though we're seeing some choppiness in certain parts, it's been a difficult period for mega cap tech. We remain very encouraged on US stocks in particular. We have an overweight to equities in our portfolio split between large cap and small cap. I think that the September rate cut is very much part of that encouraging story. But even more importantly, is what we see as an expectation for a 25 basis point rate cut at almost every meeting thereafter for at least the next year or so. And so we're really looking at a period where the Fed is going to be in a position to cut rates into a stabilizing growth environment, and that combination of lower rate plus stable or Goldilocks growth is really encouraging for U.S. equities.
Do you feel as though, Meghan, the inflation story is now done? Is it, I mean, we're not going to say mission accomplished yet, but it sure feels like a lot of investors feel as though the inflation story is done and therefore are looking to certain key cyclical parts of the market?
Well, I don't know that the inflation story is done, but I do think that what we heard from Powell and definitely what we have been seeing in the data is that the risk to the dual mandate, full employment, and stable prices are now much more balanced than they have been in the past couple of years. So you're looking at really not a recipe for reacceleration of inflation. If you look across the components, housing is finally falling in line, and we're also seeing slowing consumer demand. So outside of any sort of supply side shock, which is not, nothing that you can completely rule out ever, we just don't see the mix for a reacceleration of inflation, but we are watching some of the weakening in the labor market data, whether it's job openings or the quits rate falling, stable and falling employment, wage growth when it comes to wage growth and that inflation story. So all of that is coming together to really form an environment where the Fed should be able to cut rates, but we're not looking at recessionary conditions. We actually put a very low probability of a recession in the next 12 months.
All right, Meghan, let's talk about your word of the day. What is it and why?
The word of the day is diversify, which is really core to what we do for our clients in terms of long-term investing, but specifically as it relates to the market today. I think we looked at the mega cap tech rally over the past year or so, and it was somewhat unloved. And investors were almost looking for any sort of a reason why that bubble might pop, even though we don't think it's a bubble. And we've seen a sharp rotation into small cap. But actually, mega cap tech and the AI spend story can coexist very nicely with small cap. And if smaller companies are doing better, they have more wiggle room as rates come down, we think they will continue to spend. And that AI spend story will continue. It's going to take time. Investors need to be patient. But in the meantime, you really need to be diversified, at least across both of those asset classes within U.S. large cap, and U.S. small cap equities. So diversify is the word.